Hi, everyone. Welcome to this Wealth Management Fast Chat. I'm David Armstrong, Executive Director of Content here at Wealth Management. Today, I'm joined by Barry Martin, who is the lead portfolio manager at Shelton Capital Management, talking about turning volatility into an asset with covered calls. Barry, thanks very much for joining us.
Thanks for having me, David. Appreciate it.
So we know that in the first quarter of 2025, there were some 233 new ETFs issued. Many of those used covered calls or options-based strategies. I think in the Morningstar derivative income category saw the most rapid growth. I think in 2018, only 10 ETFs existed in this category. Now there's over 100, I think maybe $100 billion in AUM. It's a crowded space. How does your recently launched Shelton Equity Premium Income ETF, SEPI, SEPI, differentiate itself and gain some market share in that crowded environment?
Yeah, well, first of all, we're super excited that we're able to launch this product. We've been doing this for close to 20 years. We have over $2 billion in assets in the option overlay strategies. First of all, we have the mutual fund, which is 5 stars on Morningstar, EQTIX. They always manage accounts. We have basically over 1,000 managed accounts where we're running option overlay strategies. So we've had clients come and ask us for an ETF wrapper. So we're super excited, really excited about that because we're going to add our third leg to the stool. So, if a client, it's basically, we believe we can do very well because of our history and our performance. And so we've had numerous clients come our way. And so asking for an ETF and then we've delivered, really excited about it.
Why do you think those clients have come your way asking for this? Talk us a little bit through the evolution and the proliferation, frankly, of option-based strategies out there now and why they make sense for today's market.
Yeah, I think a lot has to do with demographics. First of all, you have people approaching retirement. You have baby boomers approaching retirement or in retirement. They're kind of in that odd zone of drawing off of their account and taking in some distributions, or they're looking for more a conservative approach to own equities. Covered call writing does both of that. What you're doing is generating additional cash returns by monetizing the volatility, and you do that by selling covered calls. So I don't know if people are familiar with covered calls, but basically you own a stock, XYZ, it's priced at 100. You can sell someone the right to buy that stock off of you in the future for a certain amount. So if XYZ is at 100 and you sell the January 110, someone might give you $2 for that right. If XYZ stays at that price, you take that $2 and put in your pocket. And so that $2, what it does, it acts as either a distribution that you can use to spend, or it actually reduces your standard deviation because you've used it as a hedge and you reinvested that $2. So I think it really is, for us, it's demographics and how people are using the market and using options to help them out.
Tell us a little bit about how these covered call option strategies can you provide kind of like, I guess, a third slice to a typical 60-40 portfolio. Mm-hmm. How are advisors using it? Are they taking it more out of the income generating fixed income side or the equity side? How does it fit into an advisor's portfolio?
Yeah, I think, historically, the 60-40 portfolio has been pretty solid, basically 60% equities and 40% fixed income. But then came 2022, where both fixed income and equities dropped in price, so really hurt one's portfolio. These type of strategies, a hedged equity strategy, actually did fairly okay during that time frame. So what you're doing is you're adding a different return pattern to an overall portfolio, so you're lowering the standard deviation. So standard deviation of the overall portfolio. So what we're seeing advisors take maybe 10% of their equity slice and 10% of their fixed income slice and create a new slice of the pie. CBOE actually did a really good educational piece on this, basically saying how if adjusting the 60-40 portfolio to maybe a 60-20-20, I like 50-30-20, something along those lines, where you adjust one's overall portfolio, you get better returns and better standard deviation.
So how does selling covered calls on individual stocks differentiate your strategy from some of the other ones that are out there?
Yeah. So you mentioned all the funds that are out there that have come out to the ETF space that's a covered option fund. Most of those are doing underlying equities with like a structured sale, meaning that what they're selling is maybe the third Friday of each month's expiration. So maybe they're making a trade on that Friday, and it's a structured sale where they're only going to sell an option 1% out of the money, 30 days, and it's a very rules-based strategy. what we're doing is we're looking at the underlying equity and we're looking at the underlying equities option. So we're active with the underlying equities, but we're also active with the underlying option. So with the underlying equity, we're going to look at the volatility. We're going to look at if it has an X state, if it's has earnings announcements. So all these factors in play with the underlying equity, we're going to sell an option off of that. So we're active on the underlying equity. When we're buying equities, we're also active on the options that we sell. So you see a lot of our competitors are basically passive on both, or at least active on the underlying equities, but passive on the options when they're doing index options. We're active management with both of them. So I think that's where we add value.
Makes a lot of sense. What are some of the risks that are associated with covered calls, and how are you talking to your clients, advisors about it? How should advisors be talking to their clients about the risks inherent in covered call strategies?
Yeah, so the risk with covered calls is basically it is you have equity exposure. So most of the product is equity exposure. So equities are dropping 10%, your underlying equities will likely drop 10% as well. And if you're selling a covered call only generating 1%, your equities will be down 10%, and your options will offset it by 1%, so you'll be down 9%. So you will still see some of the downward movement, most of the downward movement of the stock. So I think that's a risk that everyone should know. Second is there's an opportunity cost with selling covered calls, is basically you're selling away the upside. So if you have a dramatic appreciation of the underlying equity and you're selling options on the underlying equity, you're going to be capped at a certain level. So I don't look at it as a risk. It's more of an opportunity cost, right? You're up 15%, and maybe you should be up 20%. It's along those lines. So those are the two things that you should know. But I think, historically, or the past 5 years, the options, CBOE, and other broker dealers have really pushed education with options to advisors and clients. So I'm really excited, about that and the future of covered call writing, because it's definitely become one of the most popular strategies out there.
Yeah, and for the certainty that you get for the outcome, that might be a trade-off that some advisors are willing to make.
Yeah.
Well, congratulations on the launch of SEPI, if I can call it that, SEPI. And thanks very much for joining us, Barry Martin, Lead Portfolio Manager at Shelton Capital Management.
Thank you.